Good evening. I'd like to thank all of you for coming tonight to this presentation regarding assessments and taxes and abatements. And so I'm going to go through the presentation first and write down your questions or keep your questions, and then at the end I'll try to answer as many questions as I can, but I'd like to at least give you the information first before we start to take questions. So right now, can everybody hear me? Everyone hear me good? Okay. All right, so this is going to be about understanding property assessments and taxation. We're going to start with the staff, and we have the staff with us tonight, so as I call out your name, if you would just raise your hand, turn around so everybody can see you. I'm Kathy Temchack. I'm the Director of Real Estate Assessments for the city. We have Susan Golden in the back, who's the Deputy Assessor. We have Joe Deverin here, who's one of our residential appraisers. Jen Zanes, who's another residential appraiser in the office. Shoshona Cohn, who's the administrative assistant. And Lynn Odmanson just walked in the door. She's one of the assistants also in the office. So what are we responsible and required to do? So our work is pretty much governed by statutes. So the laws in New Hampshire and the rules that are developed and adopted over at the Department of Revenue tend to monitor or tend to dictate what we do and how we do it. So in general, we're responsible for the discovery and the inventory of property for taxation. So that means we are out looking at property, we're getting information about property, and recording that information in our files. We're responsible to value the property for taxation. We issue warrants for the collection of taxes. So every year when you get your tax bill, there is what's called a warrant, which lists every property in the city that's taxable and how much the tax is and what the assessments are and if there's any exemptions or credits, and gives us a total amount of dollars that we're to collect or that is to be collected to fund the various budgets. And then we also review assessment appeals. Now, when we do the assessment appeals, there's actually a board of assessors that reviews the appeals and actually decides whether or not to grant or deny those appeals. So the board of assessors is appointed by the city manager, and it's an unlimited term. They serve at the pleasure of the manager. Consists of 3 members. The members are responsible to sign the warrants, so they're the ones that actually sign the warrant authorizing the collection of the taxes, and they grant or deny appeals. Currently, George Hildum is the chairperson of the board, Guy Patel is a member, and John Duhamel is a member. All of the members are required to be residents of the city of Concord. And they meet on an as-needed basis. So we don't, unlike the council, which meets on the second Monday of every month, they meet on an as-needed basis. So if we need to meet 4 times a month, we're going to schedule a meeting 4 times a month. Sometimes we might go 6 weeks before we need to schedule a meeting. So how is property supposed to be appraised? So under RSA 75-1, we're supposed to assess property at its market value. So a market value is the standard that we're trying to arrive at. There's a few exceptions, actually a lot of exceptions. Over the years, they've sort of keep being adopted. So some things that are not assessed at market value. So property in current use, if you're under current use, is not assessed at market value. Residence on a commercial industrial land, so in this particular case, if you own a residence and you reside in your residence and the only use is for your residential purposes, and it's in a commercial and industrial zone and that value is higher than a residential value, you can apply to have the land valued at a residential rate as opposed to a commercial or industrial rate. Residential property developed subject to covenants under a low-income housing tax credit program. Land with discretionary easements open space land with conservation restrictions, earth and excavations of tax, land under qualifying farm structures, telecommunications poles and conduits are not assessed at market value, electric, gas, and water utility distribution assets, qualifying historic buildings, qualifying charter public school property, renewable generation facility property subject to voluntary payment in lieu of taxes, and combined heat and power agricultural facility projects subject to voluntary payments in lieu of taxes. I think that's it. Now, yay. So there's everything, the exceptions of what would not be assessed at market value. Doesn't mean we don't value it, just means it's not at that market value standard. So when do we, or how do we decide what we're going to look at when we're setting market value? So how often do we do it? Is there a specific date that we use, that we look at? And how are values adjusted? So we're going to talk a little bit more about those things. So the statutes say that annually, so every year, we're supposed to look at assessments to see if there's been any changes, and are they reasonably proportional within the municipality. So basically what that means is, if there's been some kind of change to the property, some kind of correction that needs to be made that could affect the value of the property, we need to look at that. So some examples of that might be a building permit, a demo permit, physical changes or corrections to building and land, so something's not the right measurement, there's been a survey done and it's a different acreage, anything like that that could affect the value, we need to make note of that. Zoning changes could impact the value. So if there's been a change in zoning, we would need to look at that. Subdivisions, boundary line adjustments, lot mergers, all things that we need to take a look at and see how that might affect value. Increases or decreases to the real estate market. So I know that, the last several years we've been seeing increases in market value, and market values have been going up. And if any of you remember back in the 2008, 2009, 10, 11, 12, market values were going down. And so when we were looking at values then, we were lowering our assessed values. So pretty much since about 2012, 2013 though, we've been on a system where we've seen that market values are increasing, and so values of properties have been going up. Can we just go back to the secondary? Land use approvals. So if somebody gets approval to build apartment buildings or to do some kind of building or change on the property, those are something that we would look at to see if it impacted the value. Neighborhood changes. So this could be something where they might, in your neighborhood, maybe you didn't previously have water and sewer, municipal water and sewer coming down your street. If something like that was added, that could impact your value. Could be changes in how the roads, maybe there's roads that now become a one-way street as opposed to a two-way street, so that you might have more privacy on your street, and that's possible, as might be something that could impact the value as well. We just talked about changes in the market and any other change that could possibly affect the value of the property. So if we just want to talk about that for a second, we have all these things that are going on, and so we're constantly looking at these things and trying to determine if there has been an impact. So I want to tell you that we're going to talk about in a second that the assessment date is April 1st. And so we look at everything is tied to April 1st. So what was the status of the property on April 1st of any given year? So for example, if a property had a building permit and was under construction, and maybe there was only a foundation there on April 1st, that's all we're going to assess for that year is the foundation. Even though the house might be completed and you move into the house in October, when you get that final bill in November, that assessment is still only going to reflect the foundation. It's not going to reflect the value of the completed home because it wasn't done on April 1st. It will be the following year that you would see the final assessment that would include the completed home. Okay. So how often should we be doing values? We talked a little bit about annually, and because we're a municipality over 10,000 residents, the statutes require us to hold 2 public hearings and obtain governmental body approval to do the annual appraisal. So right now, there has been a request into the City Council. They will be holding hearings in February and March on to whether or not to do a revaluation or valuation of properties at market value, and then in April they'll make that decision. So we just talked a little bit by statute again, April 1st is that year. So it's always April 1st. So again, let's say in July you had a swimming pool and you filled the swimming pool in and no longer had a swimming pool. So we would appreciate you calling us and telling us that you made a change, but we're not going to be able to adjust the assessment until the following year. So it will still be on that tax bill for the year that was there on April 1st. The following April 1st, then we would remove it. So how do we determine market values? So we look at sales. And we try to inspect all of our sale properties, and we try to contact property owners to get information, to verify information. We research and analyze all these qualified sales, so that includes looking at whether or not it was an arm's length transaction, whether or not there was any kind of personal property involved that would need to be removed from the value. We look at rents. So if it's a commercial property, we're going to look at rents, expenses, look at what's happening with interest rates for commercial industrial properties. And then once we've looked at all these values, we sort of create like a little mini model of all these sales, and we determine what adjustments need to be made to those properties to arrive at market value. Whatever those adjustments are for that mini sort of sale file, we then take those adjustments and apply them to all the properties in the city. So if one area of town, the land values have gone up 5%, based on the sales in that area, we're not going to just increase the sale properties by 5% on the land. We would increase everybody in that area by 5% because the market has gone up or down. So how do we get information? So each year we mail income and expense forms to the commercial industrial property owners and ask them to return that information, voluntarily return that information to us. We have a fairly decent response. We would always hope that it could be better, but it's a voluntary program, so they don't have to, but we, like I said, try to get as many as we can. And in this case, there's always a question, well, you know, what I'm selling or how many widgets I'm selling out of my property doesn't impact the value. And that's correct. We're not looking at what kind of business you have in there and what you're selling groceries or whatever it is you're doing or how many dresses or pairs of shoes. That's not what we're interested in. When we're talking about rents and expenses, we're talking about the building, the property itself. So if this is a retail space, what are you getting and you're renting it to somebody? What is the rent that you're getting on a yearly basis? And then what are the expenses that are involved with the building? Again, not the business, but the building. So what's it cost to plow the driveway? What's it cost to heat the building? What's it cost to maintain the building, to keep it in good shape? That would be things that we would be looking at. When people do submit that information to us, that information is confidential and we do not share it with other people, other entities. So it's not, if you do share it with us, we're not going to be sharing it with other people. But did I have something else back on that? Just we look at recent appraisals. So if we have appraisals for properties that somebody's given us, we consider those when we're looking at what's happening at values. And then we also look at rental listings, advertisements, to try to gather information about what's happening in the marketplace. So how do sales, because that's generally what people are looking at, how does sales affect your value? So we look at what we determine to be, or can determine that are market value sales. So willing buyer, willing seller, both being aware of what's all the purposes or all the uses of the property. They're knowledgeable, neither being under any obligation to buy or sell, and probably with normal exposure time. So that's sort of the big general rule of what would be a market value sale. And we get that information from the deeds. So every day Lynn can go online to the Registry of Deeds, and anytime there's a deed recorded there, she can see what's been bought and sold by people, and the tax stamps that were on there, we're able to calculate what the purchase price is. We could send out questionnaires to people to try to get more information, or if there are no tax stamps or we have some kind of questions, we may send a letter out asking you to supply us with information. Again, we may get information from appraisals that have been done for whatever reason that are shared with us. When you purchase a property or sell a property, there's a form called a PA 34 that is completed. And that information is filled out under penalty of perjury. That asks on there if the property was a market value sale, did it include anything that would not make it market value? And so we also get copies of those and look at those. We get information from our inspection. So we see that a property is sold, but what we may not know is what the condition the property is in. So that inspection is very important, because if something's selling for $250,000, what is that $250,000 representing in the market? Is that representing a property that's been completely updated and remodeled, or is that representing a property that's been pretty much original and very little upgrades or maintenance work done on it? So it's important not that we just know what the sale price is, but what the property that goes along with it coordinates with that sale price. We have conversations with brokers or realtors, and we also look at online listing services. So what's an unqualified sale? So that's a sale involving circumstances that would cause the selling price to be either abnormally high or abnormally low. And we have some examples of what that might be. So it could be a family sale. It could be where a mother and father are deeding something to one of their children, and they are going to give it to them for less than what they could get on the open market. An estate sale. A lot of estate sales generally are not reflective of market value. They're put on the market or sold because they need to settle an estate, and those properties need to be sold, and so may not reflect market value. It could reflect market value, but we'd have to do some research in order to determine that. If there's a multi-parcel sale, that typically tends to be more with commercial properties, where somebody's selling several properties, either several properties in Concord, or it could be that there's properties that they're buying in Concord and they also own one in Manchester and they own one in Derry and someplace else, and they determine that I'm going to pay $20 million for these 4 properties. And then they might go through and assign a value to each one of those properties that may or may not be reflective of the market value of the property. But typically they're going to make some kind of decision based on what's best for them and on their tax returns, on their income tax returns, about how they're going to appropriate the value. It could be some kind of court settlement that's determined what the value is going to be or what's going to be sold. A governmental sale, typically those properties tend not to be market value because there's some kind of underlying reason why the government's selling a property. So specifically, I'm thinking like if a property is taken by tax deed by the city and sold, that property may be sold for either more or less than market value, because the main thing that the cities or towns want to do is to make sure they can try to get enough money to cover their back taxes. Any other money would go to the property owner, but that's their main concern. We want to make sure we get enough money to cover the back taxes that haven't been paid, and then we want it back on the tax rolls so that money's coming into the city. Bankruptcies, short sales, a sale that includes a lot of personal property. So, and personal property, like we're talking like lots of personal property, like houses full of furniture, or if you're on the water, it might include a boat or some other, a lot of stuff. So when we talk about, you know, your kitchen comes with your stove and refrigerator, microwave, we're not talking that as being personal property. That's pretty much included in most transactions of real estate. Foreclosure sales, foreclosure resales. Again, the banks generally trying to get rid of the properties. They don't want to hold them in their portfolio, so whatever they can get for them, they're going to sell them for. Intercorporate transfers, where one corporation may sell to one of their other corporations, and so it's like a stock transfer and really not reflective of market value. Some kind of abnormal exposure time. There could be some properties, and what we find is that sometimes properties specifically are put on the market either below their assessed or below their market value, and so they sell very quickly because they are put on the market below what, if the normal marketing time is, say, like 90 days for something to be on the market, and they've priced it at way below market value, it could sell in 1 day or 2 days. And so that would be something that would not be typical. Likewise, somebody could put their home on the market and maybe the market value should be somewhere at $300,000, and they put the property on the market for $450,000. So buyers are pretty savvy, and so they're going to say, you know what, I'm not paying $450,000 for this because it's not worth that. So it may sit on the market for a very long period of time, and you may see that the price keeps going down and down and down, and at some point the buyer or potential buyer may say there must be something wrong with this property because it's been on the market now for 9 months or a year and it still hasn't sold. So that could be something that could be an abnormal exposure time. If there are long-term leases either above or below current market rental rates. So those again tend to be commercial industrial properties where property was built at a certain period of time, there was a lease amount determined, and now 15, 20 years later they're still under that same lease because the lease said, okay, it's going to be for 20 years with five-year renewals, and it's already set up back in that very year one what the lease rate is going to be for the next 50 years. So that rate could either be above or below market value. And so when a buyer's looking at those commercial properties, they're looking at that income stream. And obviously, if it's something that's a rent that's above market value, they could be paying a much higher price because they have this guaranteed stream of income coming in. Likewise, if that rent was put in very low, and it was a low rent and it still was a low rent, and the buyer's looking at that, and he knows that I have another 10 years before I can renegotiate that lease, I'm going to take that into consideration when I buy that property, and it's not going to be at what would be market value if the lease rate was at a market rate. So there's a few approaches to value. There's the sales approach, which is taking sales of property, comparing them to your property and making adjustments between your property and the comparable property, the adjustments to those sales to determine what the appropriate value would be. There's a cost approach. So that would be, what is the cost of the land? What would it cost to buy a lot today in this area? And then what would it cost to build what's there? So if you have a 3,000 square foot colonial home with 2.5 bathrooms and 4 bedrooms and an attached garage, what would it cost to build that? That would be looking at a cost approach. And then there's the income approach. And so the income approach capitalizes the income that's received from, again, not the business, but the real estate to determine a value. So what we do here is we take a cost approach, because we have to have a way to be, again, doing something consistent with everybody in the city. So we use a market-driven cost approach. So we start with a cost approach, and we make changes to that cost approach, determining or depending on what's happening in the market or the sales. So that's that market, what's happening in the market. And then on income, cost and income for commercial industrial properties, again starting with cost, and then those adjustments could be made based on what the income could be for those particular types of properties. So we have all these assessments are going on, and we're talking about they're supposed to be at market value. And there are assessment levels and assessment uniformity that we have to also be taken into consideration when we're looking at our values. So the Department of Revenue yearly comes in and asks us to report to them on all the sales that have happened in the city. What are the assessments for that year based on that sale? And they do something where they come up with a ratio that tells us what the general level of assessment is for this city. So they're looking at, and how they do that is they take the assessment and divide that by the selling price to get a ratio. So hopefully if you take $276,900 and divide that by $289,400, should get that 95.68%. So in that case, that assessment to sale ratio is 95.68. The Assessing Standards Board, which we have to follow the rules and regulations that they've adopted, requires that the overall level of assessment in a community needs to be between 90% and 110%. So we talked about uniformity. So what if it's, is everybody going to be assessed at the same level? And that's the idea. This coefficient of dispersion measures the uniformity and how uniform, or what are the number of properties that are very close. So if our assessments are at overall 95% of market value, are the majority of properties close to 95? Some a little more, some a little less, but close to 95? Or are the majority of the sales, there's a 95 and there's maybe one property that's 95 and everything else is assessed at a much higher or much lower level? There will always be outliers, because we're dealing with statistics. So there's sort of always going to be those properties that are higher or lower than the 90 to 110 if we're trying to stay at 100. And that's, we can't, we're doing a model to try to assess the properties, majority of properties at market value. There will always be sales that we can't answer why something sold what it did, more or less, and our model's not going to fit those properties. And so our assessments are going to be either higher or lower. So what that means is each strata or each group is supposed to be appraised within 5% of the overall level. So again, if our overall level is 95%, that means residentials, commercials, condos, colonials, capes, manufactured homes, the overall level should be at 95% or very close to 95%. So that means that they should be between that 90.25 and 99.75. That's where the majority of our assessments should be if we're at a 95% level. And why is that important to you? Because what happens, and this is an example, so if we put all our sales in from top to bottom, and we put the lowest ratio here and the highest ratio here, so they're in order by ratio, the very middle one is the median or the middle, okay? And that's the one that we're going to look at. So let's just say it's 1, but my COD is 25. So that COD is a big number. And what that tells me is, when I just look at that, that means there's not a lot of consistency in the values. There's a wide disparity between what's happening. So we talked about that 95%. We want to be the majority of our assessments as close to that as possible. This tells me that's not what's happening. So we get those selling prices are all about $100,000 in this particular neighborhood for 3 properties, but they're assessed at 75, 100, and 125. So what that means is, if you look at your taxes then, what happens to your taxes, you can see we're looking at a difference between $2,083 up to $3,472.50 for the same property. That's not what we want. So we have a $50,000 difference in assessment between 75 and 125, and a difference in taxes of $1,389. We don't want that. So what we're trying to do is to be something much closer. So now again we have that same median as 100, COD is 10, selling price is 200,000, assessment's 195, assessment's 200, assessment at 205. So you see right there we have assessments that are very much closer to what's happening with the assessed value, right? Sale price and the assessment are much closer. So now we look at what the taxes are. We take the 195, the 200, and the 205 to determine what their taxes are, and you can see the taxes are $54.17 on the lowest assessment up to $56.94 on the highest. So now we only have a $10,000 difference in those, what we're assessing people for, and the difference in taxes is $277.80. So again, much closer equity about what's happening with the assessments. So sort of to put this, because I'm like a visual person, so I'm trying to there's like a, written out, but visually what would that mean? So here's some, we do those ratios we talked about. Here's the sale price, here's what the assessment is. And so we look at these and we say, okay, we put them on a grid. So if this is 100%, where are my sales? So I have something here, this is 110, I have 110, this is probably 108, 105, and then I go down over here and I'm way below 90. I'm down here closer to 80, somewhere between 90 and 80%. So If I've got that kind of disparity, I need to do something. Right? I'm up here at 110 and I'm down here almost at 80. So we make, those adjustments that I talked about, where we put all this information into the computer and we create a model that we use to value the properties. So now we make those adjustments to those assessments, and you can see they're coming closer to this one, right? This is where we're trying to get as many properties assessed in this range. We've made some changes and the values here come down very close to 1. Over here, those that were way low have come up closer to the 1. And that's what we're trying to do when we're valuing the properties. And then the black ones would be ones that, for whatever reason, they were like fairly already at market value and there didn't have to be much adjustment there. So they're already pretty close to that 1. So we talk about the tax year. So there's a lot of years, right? We have the calendar year, that's January through December. The tax year in New Hampshire starts on April 1st. So remember, we talked about the assessments are to reflect what's there on April 1st. What's the value on April 1st? And the year goes through March 31st. So that is the tax year. And we're assessing you on what was there April 1st. Assessments that were mailed in the fall of 2019 reflected the market values back to April 1st. Remember, we talked about that? You're going to get that bill in the fall that's going to reflect what was there April 1st. So the bills that you got then paid in the previous year, like the January and March bill, always go to that back calendar year for the tax year. Okay, so it's not those 4 bills that you pay, January, March, July, October. That's not a tax year. That reflects 2 tax years. You got part of one tax year, which is the January, March bill, and then you have a different tax year, which is the July and October. So there's 4 components on the tax rate. The city, which funds fire, police, general services, recreation. The county portion, which funds the county jail, the nursing home, the sheriff, registry of deeds. The local education rate, which funds the schools. And the state education rate, which also funds schools. So there's 4 components on your tax bill. Basically, how a tax rate in very simplified forms is all those budgets that are adopted, the city budget that's adopted by the city council, the county budget that's adopted by the Board of Commissioners, we have a percentage of the county budget which is based on our value as a whole. So looking at all of Merrimack County, we look at what the value of Concord is and what percentage of value is that of the whole. So if our Concord value, for example, is 15% of the entire value of the whole Merrimack County, then we're going to be collecting money to cover that 15% of the county budget. The city portion of the state education formula for funding, that's much more complicated. It has to do with number of students and free lunches and all kinds of other things. But there is a formula that determines what that state education rate is. And then the local education, which is the budgets that's adopted by the Concord School Board and the Merrimack Valley School Board to fund the schools. So we figured out you take all those monies that need to be raised, subtract any other revenues or grants, so federal funds that come to the schools, and in the case of the city, that would be something like motor vehicle registrations would be subtracted from those amounts, building permit fees, etc. And then we determine, once we subtract all those, the total money to be raised by taxes. And then you take that number, divide by the total value, taxable value of the city, to arrive at a rate, it's multiplied by 1,000 to get the rate per 1,000. So when we look at like this year, 2777, that's a rate per $1,000, every $1,000 of assessment. We mail tax bills twice a year. Each mailing has 2 coupons. First mailing goes out in May with the coupons for July 1st and October 1st. So those are the first 2 payments for the tax year, are the July and October. The second mailing goes out in November with the coupons for the January 2nd and March 31st payments. And those are the other 2 payments, so those 4 payments in 2 different calendar years are the tax year. Any changes we make to values, any changes that are from the budgets that are adopted, the tax rate, are all made up in those January and March payments. So this is a question we get a lot. Why does my assessment keep changing? Why does my tax bill keep changing? So we talked about when the payments come out or go out to you. If your assessment doesn't change from the time we send the November bills, so it's exactly the same as it was then when we get ready to send the bills in May, then the final taxable amount that you paid on those January and March will be a quarter. Each one of them will be a quarter basically of that final payment. Then we do the final bills, which are the January and March bills, and they reflect that April 1st, 2019 assessment and the 2019 tax rates, which are set in November. So those January, March bills are calculated by taking what's the total amount due for the year, less what you paid in July and October, leaves the amount to be paid between the January and March payments. Again, so we talked about it, the value would be exactly the same, but a lot of times there's changes, because you remember we had this whole list of things that could be going on that could change somebody's value. And so the value wouldn't be the same as it was back on the March bill, so the value is going to be a little different, which means the tax bill is going to be slightly different. So just a review of what our current tax rates are. Currently for Concord, it's $27.78 is the final rate. And if you're in Pennacook with the Merrimack Valley School District, the total tax rate is $34.10. And you can see that the difference, that the city rate is the same for both Concord and Pennacook, as is the county. What's different are the school rates, because we're in two different school systems there. And so the rates are different for the funding to both of those schools. Just examples again. So here were our July and October payments. Were the $17.45. Now my new final value for the year is $262.1 times the new tax rate means my total value for my tax bill is $7,281. I subtract those 2 payments that were made in July and October to get the balance to be paid for the year. Divide that by 2, and that would be the January, March bill would each be $1894.91. This information about tax bills is on our website. So if you go onto the city's website into the assessing, click on assessing. Off on the right hand side you're going to find some information, and there's information on here about tax bills and how they're done if you want to review that. There are some property tax relief programs that are available for the city, and they are listed on the back of your bill, but we'd like to just review them with them because we find a lot of people sometimes say, I never knew such a program existed. Most of the tax relief programs are targeted to certain taxpayers. For example, the elderly, the blind, the low income. You can qualify for more than one. So if you qualify for the blind as well as the elderly, then you should apply for both. You shouldn't just apply for one or the other if you qualify for both. There's different kinds of tax relief, and each one of them, we're going to go over them a little bit, but each one has its own rules and requirements that have to be met. There's a deadline, first of all. So right now you're in luck, because if you want to qualify, if you think you qualify for something, you have until April 15th of this year to apply for these exemptions and credits. Once that deadline's gone by, if you come in on March or May 1st, we're sorry, there's a statutory deadline. You're going to have to wait till the next year. So please, if you think you qualify, make sure you get those applications and information in. Once you're approved, then the state also requires us to make sure that you still qualify. So at least once every 5 years, you're going to hear from us again asking you to re-qualify. So if it's the elderly, you're going to need to submit all your elderly, the information that's needed, all your income, your assets, to make sure that you still qualify for the exemption. There are annual requalifications, so there are religious, educational, charitable exemptions. And those have to be applied for annually. And if they meet the requirements, they have to show that, again, April 1st, most of these requirements are that they own, use, and occupy directly the property that they're in for their educational, religious, or charitable purposes. They also have to file financial documents if you're filing under charitable, and those are due by June 1st. So we're talking about exemptions. Exemptions reduce the assessed value of your property. So if you qualify for exemption, we're going to be removing the assessed value or lowering the assessed value before we calculate the tax rate. So here's an example. If the assessment's $200,000, that tax before exemption, $5,556. But that person or that property owner qualified for one of the elderly exemptions. We removed $73,000. So now we're going to use an assessment of $127,000 to calculate the tax bill. So the tax bill with your exemption is $3,528. So exemptions lower the assessed value. So there's some exemptions that are mandatory that you have by statute. You have to have those exemptions. The elderly is one of those. Has to be owned whole and part by somebody over 65. I'm not going to go through them. You can see that. One of the biggest ones is if you've moved here from someplace out of state, you have to be a resident for at least 3 years as of April 1st of the year you apply of New Hampshire. Net income has to be less than $46,800 if married, $34,100 if single. And net income means income from all sources. There are a couple things that are deducted. Insurance payments, if you receive insurance because somebody's died and left you insurance. If you sell your home and you have this sale or this income coming in from your home, the sale price of your asset isn't included. But if you made, say, $50,000 on that sale and you put it into some type of CD or some type of bank account, that money would apply, so that money is going to be now an asset, and we would consider that as part of the assets. But the income itself, $50,000, would not be included as an income. If you own property that's like a two-family, and doesn't mean that you can't get the elderly exemption. What is counted, though, we don't include the value of the portion of the home that you live in, but the portion that is rented out to somebody is considered an asset. And so we would go out and look at that to determine what portion of the building is being used for the rental property, and that is included as part of the asset. Net assets less than $95,000, not including your home, except that if you have rental property on that home, that part would be considered an estimate. There are different age levels and assessment levels that are reduced. So currently 65 to 74, $73,000 is the elderly exemption. When you turn 75, and that's 75 again as of April 1st, up to 79, it's $119,000, and once you reach 80, it's $203,000 are reduced from the assessed value. So if you have a property that's worth $75,000 and you're getting the elderly exemption for the 65 to 74-year-old, $73,000 comes off the $75,000, and you're only going to pay taxes on those $2,000 remaining assessed value. Likewise, if your assessment was $100,000 and you're getting the exemption for 80 and older, then you would pay no taxes, because once we subtract the $203,000 from your $100,000 assessment, there's no more assessment to tax. Blind exemption. Again, all these have a April 15th deadline to file. You must be legally blind as determined by the blind services, and the exemption amount we have here in Concord is $120,234. And there's a form that if you believe that you qualify for that your doctor fills out, and it has to be sent to the blind services, and they'll send a letter saying whether or not you qualify. Improvements to assist persons with disabilities. So in this case, the person, so notice it doesn't say owner of the property, person. The person with the disability must be living in the home as of April 1st. The deadline is April 15th. The person who by reason of a physical defect or infirmity permanently requires the use of special aids to enable them to propel themselves. So it doesn't mean just that you have some type of disability. It means that it's specifically for those who need some kind of aid to propel themselves or move themselves through the property. So the owner makes improvements for the person of assisting that person with the disability. Again, the person with the disability has to reside on the real estate, and any deductions, we deduct the value of those improvements from the assessed value. Tax credits. So tax credit, we're talking about exemptions. Exemptions remove assessed value. Tax credits reduce the amount of tax. So it's an actual dollar deduction from the tax bill. So for example, if you're getting the veterans tax, which is $150, that's removed right from the tax amount before you pay it. There's a few different veterans tax credits, and if you are a widow of a veteran, that doesn't mean that you shouldn't assume that you don't qualify. You could very well qualify as a widow or a widower of a veteran. Again, that April 15th deadline, there are requirements. You have to be a resident, New Hampshire resident for 1 year, who served 90 days in qualifying war conflict, honorably discharged, or somebody who ended service due to service-connected disability. If you're the surviving spouse of somebody who qualifies, there are certain time frames or medals in this veterans credit that would need to be met. And we have a list of those. They're on our website. They're in our office. We didn't bring those over, did we, Lynn?
I don't think we did. No.
Okay. But if you think you might qualify, again, let us know, and we can get you that information to see if you might qualify. And our credit is $150. There's the All Veterans, which is an optional credit, and Concord adopted this for April 1st, 2019. Again, April 15th deadline. You can see what the requirements are. If you go qualify for the All Veterans, then you're not getting the All Veterans and the regular veterans. You can't do both. So it's one or the other. And if you're getting the All Veterans, then you also cannot get which we're going to talk about in a minute, which is the permanently disabled veteran. So if you want to go to that. Service-connected disability. Again, honorably separated, or an officer honorably separated, and a total and permanent service-connected disability. And that's something that the VA will give you a letter that says if you have 100% total and permanent disability due to the service connections, or your spouse had that, then you bring that in, and the credit in that case is $2,000 off your tax bill. Surviving spouse of a veteran killed while they were on active duty is also eligible for a credit. And in this case, the statutes say that can be on either your residential or your non-residential property in the spouse's community. And again, that's a $2,000 credit. Something called deferrals. Deferrals allow you to postpone paying your taxes. They don't reduce your home's assessed value. They don't reduce the amount of taxes, but specifically means that you can pay your taxes at some later date. Now, in order to qualify for this, you have to apply by March 1st. Okay. You have to be disabled, receiving benefits under Title II or Title 16 of the Federal Social Security Act. No age requirement for that, so unlike the elderly where you had to be 65 in order to qualify, if you're 40 and you're receiving disability benefits under those two titles, you have to own your home for at least 1 year. You have to be living in your home. This is where it's not necessarily a given, is that you're going to have to show the assessing officials that that tax liability causes you an undue hardship or possible loss of the property. And that's at their discretion as to you need to show them that, whatever documentation or information you have that would show that. So you can defer up to 85% of your property's equity value. There's when it is paid, and it can be paid at any time. Doesn't have to be paid. Doesn't have to be wait until you sell the home or upon your death. But there's a 5% annual simple interest rate that is applied to those taxes. So now we're going to talk about the appeal process. So statutes allow people to appeal their assessment. So that's the taxpayer's opportunity to show that their assessment is either unfair or incorrect. The fact that your tax bill went up is not ground to file for an abatement. So the fact if my taxes went up $200 this year or $400, that's not a reason to file. The reason that you would file is there's something wrong with the assessment. And we have incorrect physical data. The assessment doesn't reflect market value. It either exceeds the general level of assessment in the city. Again, taxes are too high, are not grounds for an appeal. So if you file an appeal, what you should put with that appeal is any information you have to show that your home is overvalued. So compare your home to other homes in the neighborhood, other homes that look like yours. If you know of properties that have sold that you feel are better than your home, bigger than your home, and you're assessed for more than them, you would list those. If you have copies of appraisals, I'm not suggesting that you go out and get an appraisal done. Unless you feel you want to, you can, but you would supply that to us. If it's an income property, we're going to ask you for income and expenses for the past 3 years, copies of any leases that you have, copies of rental advertising with those commercial appeals. The appeal must be in writing. So you come in and talk to us tonight and say, you know what, I think my value's too high. Joe, I think my value's too high. What can I do about it? So Joe may say, okay, well, you might want to file for an abatement. But you're talking to Joe is not an abatement. It has to be in writing. The applications are available once those final bills go out. The statutory deadline is March 1st. And it's a fatal deadline. If you don't meet that deadline, there's no other deadline. It's March 1st. If you have not heard back from us by July 1st, then you should consider the appeal denied, because then there's another deadline that has to be met. If you decide you want to appeal beyond the local board, you can appeal to either the Board of Tax and Land Appeals, or you can appeal to Superior Court. But that deadline is September 1st, regardless of whether you've heard from us or not. Now, most years July 1 comes and goes, and we're still working on appeals. We're still going to answer them. We're going to get to you. But the fact that we haven't gotten to you does not mean that that deadline extends past September 1st. So again, local appeal comes in by March 1st, and then appeal beyond that either to the Board of Tax and Land Appeals or to Superior Court between July 1. You can't file before July 1 unless you've already received a decision from us before July 1, and you have until September 1, which is the deadline. There's information about how to contact us. If you don't know where we are, if you come in City Hall at the front steps, we're the first office on your right. We have our website information on there. If you want to go online and look at other assessments, you can either again come into our office and look at them, or you can go online and look on the database. I will tell you that if you click into that database, it's going to ask you for a password or have you set up a password. You need to write down that password, because the next time you go in, it's going to want you to use that password. So, communication is a key. We ask you to review your assessment records, because it's sort of distressing sometimes when we have people come in and they look at their assessment card and they find they had a garage in the back somewhere and they tore it down. They never got a demolition permit, so we never knew it was gone. But for the last 7 years they've been paying on a garage that doesn't exist. Or, you know, we have 2.5 bathrooms and I really only have a bath and a half. We want our information to be correct, so please look at your assessment card, and if something is wrong, then we want to know about it so we can get it corrected. If it's a commercial property, we ask you to submit those income and expense forms when we send them out. It may require having your property inspected to verify the information. Ask questions about, you know, what I might qualify for on any kinds of exemptions or credits. If you appeal your assessment, that does not mean that that you're not responsible to pay the taxes. Your tax bills are still going to be due. If they're not paid by the due date, the interest rate is still going to apply. If there is some kind of refund, we will refund you with statutory interest from the date you paid. A lot of times people will come in and say, you know, my assessment went up and so my taxes have gone up and I can't afford to pay this amount right now. What I would tell you is, you were going to pay some amount initially. You knew you were responsible for some amount. Please pay that amount, because otherwise you're going to be paying interest on the entire amount that you haven't paid. So if there is going to have to be interest charged, I certainly want you to be paying interest on $400 as opposed to $1,400, okay? So pay what you can, and again, the thing about the interest is it's a high interest rate, and every time you come in with a payment, you're always going to pay towards the interest first before you pay toward the principal. So what I again tell people, if you owe another $400, you get $50 saved by the end of the month, come in with your $50. You know, it sounds like I'm wanting your money, but at the end of the day, that's $50 less that you're going to have to pay that interest on. So if you get some money, come in and make those payments. So working together, hopefully we can be confident that we're assessing your properties fairly and equitable between all property owners. So that's the end of the PowerPoint presentation and my spiel for tonight about assessment. So that's just about an hour. So I'm willing and able to try to answer questions. What I can talk in generalities because I'm not familiar with anybody's specific property, so I'm not going to be able to talk about your property specifically. But if you think there is a problem, again, we'd want you to come in and speak with us, look over your card, and if you feel like an abatement is necessary, then obviously file that. So given that, does anybody have any questions at this point?
As I understand it, they go up, the taxes go up by 3% every year.
Pardon?
As I understand it, the taxes go up by 3% a year.
Her question is as she's understanding that the taxes are going up by 3% every year. Well, this year that didn't happen because the tax rate actually went down this year. Okay. That all depends. I don't think that there's like anybody has a, it's always going to go up by 3% or whatever percentage that is. But again, if you remember that screen I talked about, it's all about whatever budgets have been approved by the varying people who approve the budget, the city council, the county, and the schools. And so it's based on what those budgets are and what the total assessed value of the property is. So there's no, as far as I know, no, it's always going to be going up by a certain percentage. Yes.
I have 3 questions.
Three, okay.
So, what, for adjustments, if someone gets their land logged and they've filed a report of cut, which then they're getting taxed on that timber that was taken off their property, is that going to lower their property value? And do you work with that office, or is that something that would have to come in as ask for an adjustment?
Adjustment on the land?
On the land
Okay.
portion of your...
So the question is, if somebody cuts timber off their property and there's requirement, there's actually what's called a timber tax. There's a bill sent for the valuation of the timber that was logged. Is there an adjustment then to the land value because there was timber cut off? So corresponding adjustment if you pay $4,000 for a timber tax, are we reducing $4,000 off your assessed value? Is that what
Or
you're...
is there a percentage of it? You know, I mean, there could be a calculation, but when that report of cut gets filed and then you're paying your tax, is that taking into consideration with the evaluation of your property?
Okay, in that particular case with a timber tax and an excavation tax, totally separate taxes from your property taxes. So the fact that somebody cuts timber and gets a timber tax bill, that does not mean that that impacts the value of their land. So there's no reduction to the land value because timber was cut. So just a little history lesson, years and years ago, used to be that the timber itself was valued. So not only was your land valued and your house valued, but if you had standing timber on your land, the value of that timber when cut was valued and a tax sent every year for that. I'm not sure what year that changed. I mean, probably at least back into the 70s. They decided that that was not going to be how they were going to tax timber. So now timber is only taxed when it's removed from the property, and it's 10% of the market value of the timber when it was cut is what the tax is. And that's a completely different tax than your property tax.
Okay. You mentioned something about a disability. So if someone in your home has a disability, so would something like a ramp being installed be something that would qualify
Yes. Okay, so you need to, again, the person who has the disability has to live in the home.
Yep.
Be there on April 1st, and the disability is one that requires them to have something to propel themselves to move. So, you know, a wheelchair or something that, okay. So if you build a ramp so that person can get up in there, in and out of the home, then yes, if we would, typically we would go out, note that it's there, and we would not assess you for that ramp because it's being used for that purpose.
Okay, so what happens if you buy a home that has something in it already that was put in for disability? Is that something that should be noted on the tax card?
If you're getting that exemption, we note what those properties are. Currently we have 2 right now. We only have 2 properties, so we know which 2 they are because they've applied, we've been out, and we check with them to make sure that every year that the person that's with a disability isn't still, in fact, they have to show that they're still living in the property.
Okay. And then the third question is, when the assessors are coming, say they want to inspect the land, do they have to have the owner's permission to like walk the whole property? Or,
so when you say we're coming out to look at your land,
I say usually when there's a house sale that goes on,
okay,
you know, sometimes you put a note in the card, we were here. Besides putting that note in the card, do they have the right to then walk the whole property?
unless your property is posted with a no trespassing sign,
they do.
then we would not go on the property. We would, if we needed to, if you were a sale property, then we would be sending you a letter asking for you to call us to set up an appointment.
Okay.
If there are no trespassing, if there are not no trespassing signs and it's not posted, then we do go up to the door, knock, and if there's a building permit, we go a deck in the back or whatever, we're going to pick that up. We're going to leave a card there letting you know that we were there. If it's something that requires us to go inside, so maybe you've done some kind of work inside and you're not home, then we're going to ask you to please call us so we can go out and see if that work's been done and adjust the value, whatever needs to be happen.
Thank you.
Yeah. Any other questions? Right here.
So we specifically saw a substantial increase in our property assessment in the last year, like $35,000+. And so I guess one of my questions is, in the letter we got, it indicated that you even considered the fact that the interior had been painted as part of the reason that the assessment had been increased, and I'm a little confused as to why that is. I understand that, you know, making improvements to a property improves the assessed value, but at the same time it almost comes across like there's no incentive for people to make improvements to their house if their assessments are going through the roof. So,
well, the incentive is that someday it's going to be worth more because you've put the improvements into the property, and you hopefully will get more than somebody who's not done any improvements. So if it's just painting your house inside, painting the rooms, that's not.
there were other things. I just thought that was an odd inclusion. But I guess my other thing is that at some point you're going to start taxing people out of their houses.
So again, our role is to assess properties, so I'm concerned with the assessed value. We live in New Hampshire, which has a certain tax structure, and that tax structure says that we don't have, for the most part, we don't have a sales tax, we don't have an income tax. And so we're funding government, schools, the county. The only tax they have is a property tax. And we can only do what the government, what the state allows us to tax. So if they don't allow us to, you know, there's been some other things put forward to allow different changes in the tax structure, but if at the end of the day the legislature doesn't approve that, then we can't do that. So I guess my Again, I wanted to say we're focused on the assessed value, and if the market continues to go up, and we've been in an appreciating market, and a very strong appreciating market, and there are certain property ranges that I would say they're much more affordable, and they're become the affordable housing. So pretty much anything that's under $275,000 is considered affordable housing, and the market is very quick to look at those properties and to pay, a higher value each year. It seems to be going up and up. But again, it's our role to assess properties at market value, whether or not, it's going to tax somebody out of their house. Unfortunately, that's not something that I can change. The only way that that's going to change is basically unless the tax structure changes across the street. That's what we have right now, and so that's what we have to work with. So, but you've been back to your point, your question about making improvements to your home. So if you are making improvements, like you had if you have a 1950s house and you had the original heat system and you put in a new boiler and you've put on a new roof and you've updated the kitchen and the bathrooms, that definitely impacts market value, and some of that can be substantial impact on market value, and that could increase the value of their home, definitely. Yes.
I have more questions. I know you're the messenger, I understand that. So.
Pardon?
I know you're the messenger, I understand that. So, what about the condition of the property? Because what if the properties around yours are condemned?
Okay, so the question is, if there are properties around yours that are condemned, does that impact the value of your property? It could. It would depend, and if there's sales around there, and we're seeing that there's sales that are occurring that are going down because of those types of properties or blighted properties, then that would certainly be something we would take into consideration when we're trying to set the value. Or the sales may show us that doesn't matter. Somebody's still paying this amount and it's not really impacting the value.
Is depreciation taken into account?
Depreciation.
Yeah, I'm talking about mobile homes. They don't get better.
That's what people tell me, but we have homes in the city that manufactured homes that are 50 years old or older, and if that was the case, that they went down in value, they'd be worth zero. But unfortunately, that's not the case, and those properties are still selling, and so whatever that market is what we're going to take into consideration. Now, obviously, you're talking about condition, so if you feel that there's a property that we just talked about, with this couple over here, we talked about, giving examples of things that would increase the value. So if your home is pretty much all original kitchen, original bathroom, original flooring, original heat system, you may want to look what we have on the assessment card, and that would specifically go to something that we call condition and what condition we have it in. So not knowing your specific, what one you're talking about, I would say that's something I definitely would look at.
So, to clarify, what you do when you assess is you take what it would take to put a new unit in comparable to what is already there, what it would take to put a new one there.
So, okay, are you asking me like if it's going to cost $3,000 to put in a new heat system, or are we going to reduce the value by $3,000? Is that what you mean?
No, I'm asking for clarification on the market-driven assessment.
Mm-hmm.
You take what it would cost to buy a new home, and you assess it at that value.
All right. Just want to make sure I'm under, so I take what it would cost to build a new home.
Right, what you were saying for the market-driven, you look at what it would take to build a new home or put a new home there, or...
So that could be an example of the cost approach that we talked about. So if we're using a cost approach to value, and if it's a property that has a lot, then we would try to determine what's the market value, what's somebody going to pay for the lot, for the piece of land. And then if they're going to need a well or septic system, what kind of cost would that be? And then what's the cost to build the home that's there, do the backfilling, put in the landscaping, all of those things. What is that total cost? Cost does not always equal value. So, you know, a lot of times, an example would be if a builder's buying this lot and building this house, so maybe between the lot and the building, he might have $250,000 into what he's got. But when he goes to sell it, it may sell for $300,000. So there's an example where cost doesn't equal value, okay? So that's when we talked about that market-driven cost approach. So we can say, well, we know that actual dollars outlaid to build this property cost $250,000, but when it went on the market, there was this sort of premium that was paid for that property for $300,000. And so we're going to try to value it at closer to that $300,000 than the $250,000. That would be an example where cost doesn't equal value and the value is higher. Conversely, there could be things that you do to your property or that you put on your property that may not be a return on the investment. So an example that might be probably one of the easiest ones is if you build an in-ground swimming pool, okay, and a pool house, and you spend $15,000 or $20,000 to put in that pool. The likelihood of you recapturing that $20,000 when you go to sell that property, very slim. So it's going to be swayed some fraction. I don't know, it could be 30% of that, or you know, a fifth of that. So again, cost doesn't always equal market. You know, in a home, I'm just trying to think something that may be more, so if it's not a pool, then there may be certain homes that are being built that maybe you want, and because your particular instance, you might need 4 bedrooms in a home, and so you go into a home that maybe has 3 and you start putting up walls and you're making 4. Depending on the size of those rooms, may become something that, yes, I've put X dollars in, but I'm not going to recoup that because maybe the market really in that area, in that particular development, really wants 3 bedrooms, and 4 bedrooms isn't really what it wants, and especially when they're that small. So does that help you at all, get some kind of sense of? Yeah. All right.
To interject real quick.
Can you interject?
Are you talking about like the mobile home example, like you pull out an old mobile home? So that's where the age and the updates, like she was saying, as you swap out the old with the new, roofs, heating systems, kitchens, it lessens the depreciation. But if there's still a 1965 mobile home on there, it is depreciated more significantly than anything newer. We take the age and the overall condition for its age into consideration where we're looking at them.
And the condition would include any
right. And so when you look at the
improvements.
Yeah. So when you look at the square footage, you know, we're saying a new 14 by 66 vinyl sided mobile home with this and this, but then we depreciate it down according to how old it is and what type of upkeep has transpired over the years.
Do you have a particular percentage of depreciation already?
No, and that's where it.
That depends on, again, on the market. So you're saying, you know, mobile homes keep going down. Well, again, that's really, they're going down, they're only going down probably is if they're not being upkept in any way. And so now the roof has started to fall in and you got holes in the floors, then then I'm saying the value would be going down. But if you're doing regular maintenance work to maintain the value of that manufactured home, it's probably not going down in value.
So when you assess, do you assess them against all communities, rural communities, or is it just in the area?
So when we assess properties here in Concord, so every year we're looking at all the values. So remember I talked about we take all these sale properties and we sort of create a little mini model of the city based on those sales. And so we look at type of property it is, whether it's a manufactured home, whether it's a condo, single family, commercial. We look at where it is, we look at the age, we look at the condition, and we make adjustments to this model to assess those properties as close to market value as possible. So that may mean that I might need to give more depreciation, it might mean I need to give less depreciation, it might mean that certain areas of town have appreciated more than others, okay, and some not as much as those. So once we determine what all those adjustments are that fit our model for all those sales, then we go, so if it's a manufactured home park, and let's just, pick one, whatever one it is, in that park, if the sales show that the values have gone up 15% in that park, then we're going to make adjustments, and not everybody necessarily, because it depends again on the size, the age, the condition, may not go up exactly 15%, but those adjustments that we're making to get in that area are all going to be applied to all the properties. So, same way with residential, if it's a single family home in the south end and the south end is going up by a certain percentage, then they might be going up 10%. And the ones across the river on East Concord, maybe they're only going up 7%. So at the end of the day, those adjustments that we've made are going to be placed on everybody that's either in that neighborhood or that type of property. So if ranches are going up more than capes or colonials, then the value of the ranches are all going to be theoretically going up. More that so than the colonials or the capes or something like that. Yes?
What is the level of tax delinquency within the city? Is there a percentage, and is it in the norm?
I'm sorry, what? So is there a level of what?
Tax delinquency, is it?
Tax delinquencies?
Yes. Is it like 2%, 3%? Is there a percentage? Is there a?
I don't know off of my head what it is, but I can tell you that I think Concord has a very good payment of taxes by their property owners. Again, back when the recession hit back in 2008, so there's a period of time that a lot of people couldn't afford their taxes, and there were a lot of delinquent taxes in that period of time, and more so than what there is now. But I would just tell you that I think Concord has a pretty good rate of payment of taxes. But that's if you really wanted to know what percentage. I'm guessing if you called the tax collector, she may be able to tell you exactly what the percentage is.
All right. Thank you.
Yes.
When using sales for comparable properties, how far back do you go? So
When we look at sales, how far back do we go? For commercial properties, we're probably looking back as far as 4 or 5 years, just because we have a lot fewer sales of commercial type properties. Residential properties for the last couple years, Lynn, we've had what, 1,400 sales in a given year? Somewhere in that neighborhood. probably the last 2 or 3 years, we've had probably over 800 arm's length sales in the city that we've looked at. So, you know, we start with those, whatever that number is, and then some of those get weeded out because they're the ones that we talked about. But, so about last few years, we've probably had at least 800 or more good sales
So you're not
each
really
year.
happy to go back more than maybe a year?
So going time period then, so we talked about going back 5 years on commercial industrials. So for the values that were set for April 1, 19, we looked at sales for residential properties, so commercials, manufactured homes, condos, April 1st, 2018 through June 30, 2019. So sales that occurred in that time period were the sales that were used to set the values for April 1st, 2019. I'm sorry.
I'm sorry.
Go ahead.
Did I hear you say that new roofing could have an effect on assessment?
I'm sorry, could you?
New roofing? Did I hear you say that new roofing could have an effect on an assessment?
So would a new roof, could that impact your assessment?
Yes.
Yes, it could. If you previously had a roof that was not in good shape and needed to be replaced, and you put on a brand new roof, then yes, that is something that could impact the value. Yes. Yes.
Okay, I probably have 25 questions, but I'll ask them one at a time.
I don't know how long my voice will hold out for 25, but
Okay, anyway, the first question has to do with, you're talking about, you know, basing on values, and for instance, we've had some very huge, you know, increases in assessments on mobile homes because one home in a park will sell. They probably spent several $1,000s fishing it up to sell it, so it's one of the better ones in the park, and so it's going up more than, say, the typical home that has been fixed up. They still get the full increase on their assessments, while at the same time, a commercial property, you know, somebody buys a commercial property for more than the assessment value, and you don't increase their assessment, and you don't increase the assessment of the surrounding city.
so generally, if you split, we'll talk about the manufactured homes first. So manufactured homes, if there's one sale in a park, and so if, you know, maybe there's only 18 homes in this particular park, and we have one sale, that one sale could tell me something about what's happening to the market value in that park. But I have 10 other parks in the city, and if in the 10 other parks, every sale or the majority of the sales are selling for more than my assessed value, then that tells me something about what's happening with manufactured homes as a whole. Okay, regardless of what park they're in, if their assessments are lower than the sale prices, that tells me the market value is going up. So then what I try to look at is, on this, if I don't have any sales in a specific park, just like you would do, like if you were assessing a home, appraiser was appraising a home, and I have to find comparables, I'm looking at parks and saying, okay, is this park similar to this one over here where I have some sales, and what's happening there? Did those values go up 5%, 10%, and is that something that would seem reasonable to what would happen over here? And so that's how we would basically sort of make those adjustments. You mentioned commercial properties sell for X and we might sell for more. Again, we analyze those sales, and just because something sells for something doesn't mean that that's the market value. Because there could be, as we talked on commercial properties, there could be reasons why somebody's paying that. There could be a long-term lease that's above market value, and so the law says I'm supposed to consider what's the market value lease. The fact that there's a lease above market value is, I'm not supposed to consider that. What would be the market value lease? So we look at those sales, and if we need to adjust them, we adjust them. But being an assessor or being an appraiser doesn't mean that if something sells if every property that's sold, that I assessed it for what it sold for, there's a term for that, and it's called sales chasing, and it's illegal. So if I'm just taking a value and increasing this one and ignoring all the other ones, I can't do that. If that value or that sale is indicative of what's happening in the market as a whole, then it's something I can do something with and maybe adjust values. But if it's not indicative of what's happening in the city overall, I can't just change the value to X because it's sold for X. Likewise, if it sells for less than what I have it assessed for, there could be a reason why it sold for less. Okay? I don't know what that reason could be. You know, I'm off my head, but I'm not going to go out and just lower the value because it's sold for less. Again, that's called sales chasing. So unless there's a reason it's sold for less, then I think there's records or reason to show that everything should be less. I'm not going to just adjust the price for one because it's sold for this. That's just not how it works. Yes.
Okay. What I'm interested in is, you've been talking a lot about comparables and sales, but when you gave your presentation, you said the value of homes is based on cost, which is one of the three methods of assessing, and the value of commercial properties was based on cost and
income adjusted cost.
And so you didn't say that sales were a component of how you assess properties in the presentation, but yet in all your discussions, that seems to be a very important component of how you're assessing the properties. And in fact, that's one of the things that's included in the application for whatever it is, adjustment, revaluation, is comparables.
Right, it's comparable properties. So what, again, so if that property that you're talking about sold for $600,000 and I have it assessed for $400,000, and that $600,000 is something about that property that isn't reflective of market value, I'm not just going to go out and increase the $400,000 to $600,000 because it's sold for that. If it's sold for $600,000 and I look at everything else and I say, you know what? That is something that seems to be happening and changing, and I need to look at those properties, and that maybe the value does go up and I increase other ones too. It's not just the one. All right, this will be the last one for tonight.
Okay. I mean, once again, we're coming back to, you seem to be, basing valuations on sales, even though that wasn't one of the methods you said you used in the presentation. I mean, like, for instance, my house. You say it's based on some form of adjusted cost. Well, if I was to take the historical cost of my house, I don't know, it might be $15,000 or $20,000, because it was originally built back in the 1800s out of cheap materials and has been added to randomly ever since. So probably the amount of money that's been put into it might be $15,000 or $20,000. On the other hand, if we were to say what would be the cost to replace it, it would be like $1 million or $2 million. You couldn't use a square, you couldn't use a level, you couldn't use any two pieces of dimensioned lumber, so you couldn't replicate that thing for any reasonable amount. So once again, you apparently are assessing it based on sales of comparable properties, but I'm just that's not one of the methods in your presentation that you said you used to assess residential property.
I have to start with a cost approach, and the reason I start with a cost approach is because I'm not probably going to get into every home. So whatever facts I know about something that will contribute to cost, I'm going to start with that, and that cost is adjusted, and it's cost not what you paid to build it 50 years ago. It's what would it cost today to build this property new, and then it is adjusted for wear and tear, or how good the maintenance has been on the property. And that's based on what we can see and what the market is saying. That's why I said initially it's important for us to know what that $250,000 sale is for. What does that represent? Does that represent something that's brand new, or does that represent something that's a home that's basically all original? That's important to know, because that goes to the depreciation, and what do we need to do with that? Because if the house that's sold with no maintenance, no work, is $250,000, And I have one over here that's been upkeep, kept, and improvements to it, that might sell for $325. But I'm going to start with the same cost approach, and that goes, the difference is going to be in the depreciation, which is what Joe mentioned up here. So I thank you all for coming. We do have information back here about the elderly exemption, if that's something you think you qualify for. If you think you want to file for an abatement, we do have abatement applications back here as well. So thank you very much for coming.